One. Good morning. My name is Don Daniel, founder of Pill Method International. And this morning we are in the mortgage syndicate. We're going to be talking about becoming your own bank this morning, starting your own family bank. We're here to tell the truth about how mortgages, how lending, how money actually works, and how, we need to be able to take advantage of our money. Listen, we're out there making it, right? We are attempting to make money to grow wealth. But right now, there is somebody out there. There's somebody out there that wants to make your wealth their wealth, siphoning off your wealth, siphoning off your legacy, trying to make it theirs, and at the same time, make you think you're doing the right thing all along. That's what is going on here, folks. We have been following the best practices of financial gurus for a very long time. And if you spend any time in this room, in fact, I'm going to tell you right now, if you're taking down some notes, one of the things you need to do is Google P.I.L.L method. Just try it. Google P.I.L.L method and see how long we've been out there and how much information is out there. Okay. So today, I think, let me see. I don't even remember what show this is today. Hold on for a second. Let me pull that up just a minute in a new window here and go over to YouTube. And, all right. So today, is episode 128. Episode 128. Folks, this is what's going on. We have 128 2-hour shows up about how to pay off mortgages in 7 years and everything that's around what it takes, not only to cut your interest costs by 75%, but to build wealth at a phenomenal rate by taking that money that used to go to the bank and investing it in yourself. All right. So how many people here want to know how to grow your money? How many people here want to learn how to become your own bank? Go ahead and put a number 9 in the chat if that is what you want. If you want to learn how to become your own bank, how to use your money wisely, how to stop letting other people siphon off your wealth, put a number 9 in the chat, because we're going to go over some basic stuff in here. And at the top of the hour, Flame Newton, a credit guru, credit expert, is going to be coming into the room and going to amplify this information that we're getting now. So, oh man, listen, I see the number 9s in the chat. I see the number 9s in the chat. So let me bring up my show notes, because right now you're working hard. You are working ultra hard to receive your wealth, to grow your money, to make money. All right. And then the idea of when you make it, how can you best use it? How can you have a good life now and a good life to come by optimizing the use of that money, by how to purchase so that you'll have more money left to do other things. So you still want to purchase your car, you still want to purchase your house, you still want to purchase education, you still need to purchase the finer things of life. To what makes life enjoyable, you need to be able to purchase those things. All right. But also not just purchase those things, but you need to grow your wealth at the same time so that you can live life well now and have a life after working. Oh my goodness. Do you realize that too many of us right now are going to outlive our money? We're living longer. I mean, medical advances are causing us to live longer. And folks, you don't want to outlive your money. You don't want to have a good time now and have a worse time later. You want to have a good time now and a better time later. And there is a way to do that. So if you have any questions, if you have any concerns, if you have any ideas about how we're going to do this, please come up to the stage. I want to hear from you. I want to get your questions. And we have some party hats in the room. I am so glad to see party hats, new people to Clubhouse. They've been on less than a week, and that means they're in this room wanting to learn more. So listen, if you're new to the room, the Mortgage Syndicate is a great club to join. So go ahead, go up to the top and click on the Mortgage Syndicate. Oh, and I forgot to tell our engineer. Listen, folks, could we, Kurt, if you have a moment, I don't know if we could be able to do it for this show or the next show, but I'd like to create a graphic that says read and review, because right now we need to read the book, and then review the book. Because today, because I don't want to forget it. I forgot it. I forgot it on Friday to tell you that the book is actually on sale. My book is actually on sale on Amazon. I think it's like 23% off. 23% off. My book is 23% off. So if you want to go to ice10k.com or ice10kbook.com, or just go to Amazon. Okay. You will be able to see my book there. And right now, let me see if I can pull that up on the screen. I want to show you something because let me see here. Let's go to Amazon. We're going to put this on the screen. All right. Amazon. And so you can see what we're talking about. All right. And put the book in there. Let's see. There we are. All right. We're pulling that up now. All right. And if you want to go, let me put this on the screen and pull this over here. There you go. I want to show you a couple of things. All right. It's 23% off right now. 23% off right now if you're watching this online. And if you do want to watch some of our stuff online, because we're going to be putting some very powerful examples on the screen. And if you want to see them, you want to go to ice10kvideos.com, ice10kvideos.com, or go straight to YouTube and then click on subscribe and then watch the live. You want to be able to see some of these examples. But today, look at here, our book. My book is 23% off. Grab it while you can. And Amazon has said there's only 5 left in stock. Listen, well, let's see if we can talk to them and make sure that there's more available for those who want to get the book at 23% off. Not only will you get the book at 23% off, I want to show you something about the book. Let me go down here and click on the book here. And we're scrolling down, and all right now, boom, we're pulling it up, and my book, both versions of my book are in the top 10. All right, so we got 1, 2, say Amazon bestsellers here, and let's see, the Kindle version, the digital version is number 3 right now, and the paperback is number 8. Look at that. All right. And that's all thanks to you. So thank you so very much. Those of you that are supporting the book and continue to buy the book. But right now, the paperback version is 23% off. And when you get the book, folks, here's what you also can do. Do you see that card, that link above my head? That's my 10K card. If you would like to have your very own 10K card, a business card, whether it's for business or for personal use, it is a great digital card. It's the best thing going right now. So you can get your own digital card and by purchasing the book and following the steps. Go to ice10k.com. And then, listen, I'm going to the link myself. So we're going to ice10k.com. And then you'll see step 1 is get the book. All right. Step 2 is get a savings and earnings report. We'll talk about that a little later. But step 3 is to claim your 10K card. How do you claim your 10K card? Step 3, follow the instructions there when you click on number 3, and then you will screenshot your receipt, and then upload that your receipt, and follow all of the instructions, fill all of that out, and then also click on where we can send your card, and then you will be able to receive a 10K card from us. Oh man, just for purchasing the book, folks. That's a $100 value. You get a book on sale, plus get a digital card. That's a $100 value that even the 10K card company doesn't even offer this on their website anymore. They don't offer the basic card on their website anymore. The only place you can get it is here when you purchase the book. All right, folks, listen, we're going to take this off the screen, and let's take the screen off, and we're going to get things going here. Get rid of that. Boom. All right, put that back on the screen. Okay, so let me get back to where I can see what's happening. All right. And well, Dion, good morning, Dion. I see you out there. Folks, can you share the room a few more times for me? Share the room a few more times, because there are people out there that want to know more about becoming their own bank this morning. So here's what we want to do. Okay. What is the wisdom? What is the wisdom that's needed to make money and hold on to your money and build your money? Okay, there's a certain wisdom that we want to be able to look at. Now, there's more than one way to grow your money. Now, I'm going to give you one way that a lot of people are not aware of, in becoming your own bank. And the idea is called infinite banking. Infinite banking. So write that down. All right. And there are books out there on infinite banking, and you want to look it up. So this is just one way. So what we want to do is make the money. All right. Learn how to efficiently spend our money, learn how to leverage our money, and then learn how to grow our money. And we have to be strategic and intentional about that. All right. So if there are any insurance agents in the room right now, please raise your hand, because we're going to be talking about infinite banking. We're going to be talking about permanent life insurance today as a one way to become your own bank. And I only have time to talk about the one way this morning about becoming your own bank. And we're going to set this thing up so that you can make sure that you have plenty of money to do this with. So I'm going to, before we get into that, I got to talk about how you're making your money. Okay. How much money are you making? And do you want to make more? And are you putting yourself in that position to do your very best with what you have? Here's what I know. You are designed as a human being to be the very best you can be. When we open ourselves up to receive information that is not only good for us, but good to us, information that's good for you and to you. Yes, there is some good information out there about finances that's good for us and good to us. Let me tell you about what's going on with the way that we tend to look at money now, the way education, money education is taught now, financial literacy. Banking right now produces a ton of information on financial literacy. In fact, if you go to your major banks right now, you can give them a call and say, I am going to hold a seminar on financial literacy. Do you know that all the major banking institutions have free information on how to understand and build wealth? All of them. But I'm going to tell you right now, you don't want it. A banking institution that gives you free information on how to build up your net worth, how to make sure that you are using your money most effectively. Let me ask you this question. If you were building a chicken coop, okay, if you were building a chicken coop, would you want instructions from a fox? Anybody? Could put it in the chat. If you were building a chicken coop, somebody asked me, Mr. Don, does the Kindle purchase qualify for a 10K card? Yes, it does. Okay. The Kindle purchase does qualify for a 10K card. Thank you for asking that question, Ms. Dion. And Darlene says, no, they wouldn't want, listen, no, they wouldn't want to get, if they were building a chicken coop, they wouldn't want to get instructions from a fox. No, 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 no. So here's what we're saying. If you want to grow your money, if you want to make the best for yourself and for your family, my question is, do you really want to get information from the bank? No. Why are banks in business? Why are banks in business? To make you rich? Are banks in business to make you rich? That's first of all. Are they in business to make you rich? Anybody else? Okay. I'm looking for the answers online. Okay. Are banks in business to make you rich? Okay. Oh, no. Darlene said no. They're not in business to make you rich. So listen, folks, when you get information from a bank, you're only getting partial information. The partial information makes you think now you're going to be better off than doing nothing. Okay. They give you enough information so that you know you're better off than doing nothing. But are they giving you the very best information that's out there for you? This is why we wrote the book. This is why you need to get this book. Out of 33 million titles, there's only one book that helps you to understand how lending actually works and how you can take advantage of it. Wow, wow, wow. We have Queen Red on this morning she is on YouTube this morning and taking this all in. And we're going to jump in here right now and see a little bit about how we want to get some information on how we can take some money that we would normally spend and feel good about it. But I'm going to tell you, you don't have to spend it. Listen, I'm going to pull up another example here. Let's pull up this one. This is an example here. I want to show you something here. All right. This is a brand new mortgage, $322,000. $322,000. All right. Is everybody seeing this? I need you to see this. I need you to tune in to what's going on here. And it's at 3.625% interest rate. Now, when we're buying a home, we generally want to get a loan for that home. And I fully endorse borrowing money to buy a house. I do not endorse paying cash for a house ever. Don't ever do it. Don't ever do it. Listen, folks, don't sit in the audience. Don't just sit in the audience. If you have anything to contribute to this conversation, please come to the stage. This is a safe space. All right. Even if you disagree with me, come on up to the stage. Let's talk about it. Okay. So we have 7 shares in the room right now. Okay. We have some comments. All right. And I'm going to be trying to watch all of this. So anyway, let's go ahead and get everybody going here. So I need you to see this right now. In the first 3 months, here's how this loan looks. Paying down the loan by $1,250.68. You see, folks, I need you to understand that your equity costs money. There's a cost to acquiring equity. Equity means how much my house is worth and how much I owe on it. Okay. So if I owe if my house is worth $200,000 and I owe $100,000, that means that's $100,000 in equity. Okay. There's a difference between how much I owe and how much the house is worth. So now we're coming in at the house is worth 300 some $1,000. Okay. So now when we pay the house down, then we are creating equity. So if the house is worth $322,000 and I pay it down by $1,250.68, that means I just created $1,250.68 worth of equity. Does that make sense to you guys? Now, let's take a look at the number in the red. This equity that I just acquired in over 3 months only cost me $2,442.65. Folks, do you believe that $2,442.65 is too much to pay for $1,200 worth of equity? Anybody? Do you believe that $2,400 is too much to pay for $1,200 worth of equity? Does anybody believe that that's too much? I need to see that in the chat. Okay. Somebody said, absolutely. Thank you. Big shot says, absolutely, that's too much to pay. All right. So listen, let's see what else is going on in the first 5 years. Now, listen, folks, as you're paying on this home, do you realize over 5 years, your home gets easier to pay? Does anybody know why your home gets easier to pay after 5 years? And while you're contemplating that, I need you to, if you want to see this, go to ice10kvideos.com or go straight to YouTube and watch it there. And you listen, you can also watch it on, we're also right now on we're on Clubhouse, of course, but the live video is on YouTube. It's on Facebook, on Twitter, and on LinkedIn. So if you want to watch us on any of those, go right ahead. Okay. All right. So Victoria says, because most of the payment goes towards interest in the beginning. That's right. That's right. Most of your money goes to paying interest, but it gets easier after 5 years because you start to pay less interest after about 5 years. Now, here's the other reason. Hopefully in 5 years, you're going to make a little bit more money. So if you're making more money and you're paying less interest, your loan gets easier to pay because generally your payment will stay about the same. Now, the only reason it's going to change is if the taxes go up, if you're escrowing, and that's another thing. All right. If you're escrowing, meaning if you're adding your taxes and insurance to your mortgage payment, that's the only thing that can change. If you don't refinance. So yeah, your payment might get a little bit more, but it's not because of the loan contract. It's because your insurance may go up or your taxes may go up or both. And then that will change your payment. But your loan contract does not change. So make sure you understand that. Now about escrowing, about adding your mortgage, about adding your taxes and insurance to your mortgage payment. I don't recommend it. If your mortgage company will allow it, opt out of doing that. You can save that money yourself because all they're doing is putting that money into a savings account for you. They're putting in a savings account for you and you're not getting any interest on it. And then they're paying your taxes and insurance for you. So I'm just showing you some of the things that are being used to siphon your money off. And by them using your money, they're making big bank on your money by putting it in an account that pays you no interest. But guess what? Because of what's called fractional reserve lending, every dollar that they have on deposit, they can lend out 10. They're making trillions of dollars just on the monies that are sitting in escrow accounts. I'm not even counting the interest they're collecting. They're making trillions on just your money sitting in an escrow account for a year, and then they pay your taxes and insurance for you as a quote unquote benefit for you. No, no. So remember, you don't want the fox giving you instructions on how to build a chicken coop. You really don't. So here's what else is going on, folks. Here's what else is happening. So we're going to scroll down here and see what would happen after 5 years of just paying the bills, just paying the bills. If you're online right now, if you're watching this right now on your favorite platform, please share this out right now, because we're going to get into deeper into how we have been taught to handle our money, but it costs us big money. Now, it's enough to pay more than you need to, but I need you to understand this part. It's more than just paying more. The more you pay, that's a problem. But you know what the biggest problem is? The money you didn't make that you could have made. The money that you didn't make that you could have made because you spent that money that you didn't need to spend. Because banking is all about getting you to use your money inefficiently. What do I mean by that? Here's what I mean. If you have a mortgage where you're making a mortgage payment and 80% of that money you're paying goes to interest, that means only 20% is paying down the loan. Now, if you take a look at just an individual dollar, this is what it means. For every dollar you pay on your mortgage in the beginning, every dollar, what if you actually could see 80 cents of that dollar going to interest, not helping you, and only 20 cents out of every dollar is going towards your mortgage, paying it down? Who wants to do that? Oh my gosh. I got Aaron out here who wants to come to the stage. All right. Oh, and he's a mathematician and an educator. I absolutely love it. Let's invite him up. All right. Invite to speak. Mr. Aaron, come on up. I think, do you have something to add to this? Is there anybody else that has something to add? I got Mr. Moses. All right. See if Mr. Moses wants to come on up. All right. Where are you? Where are you? Okay. Wants to come up as well. Invite to speak. All right. We just invited Aaron and Moses up to speak. All right. Good morning, Aaron. And how are you doing, sir?
Good morning, sir. I'm doing very well this morning. About to head out and for some business meetings on some very similar topics. You caught my interest, but I was going to wait for a natural break to ask you a few questions.
Oh, listen, let's go. Since you've got something going on, let's go ahead and get to your question now. Because listen, this is being recorded, so people will be able to get the whole gist of what I'm saying over the next 2 hours. Go ahead with your question, sir.
Awesome. So I heard I've only been in the room for a short while. I got really excited. So there's a matter of there's two things at hand here recently. You said I believe you're speaking about the rate at which you pay it debt, right?
Mm-hmm.
Um,
Mm-hmm.
and then you said there's also this concern of the money that you didn't make that you could have made. And
Exactly.
I did not expect that at all. I thought you were gonna say I thought you were gonna speak on front loading paying down that debt, right? Paying it early as possible to because you're fighting, time value of money. I said, oh wow, that was a different approach. I was wondering if you could, go further into that. I, I didn't. It was just so surprising to me. I didn't see that coming.
Most certainly, man. Most certainly. So here's the thing: is that when you have you ever bought something on sale?
Yes, sir, for sure.
Okay, I like buying stuff on sale. All right. So if I buy something on sale, All right. Let's say I buy a set of tires. All right, and I save $200 on that. Okay, I just saved $200 on that.
Yeah.
You follow me?
Yeah, for
But
sure.
somebody else that didn't have the coupon, they paid full price.
Hmm.
So it was something that they needed, but they paid $200 more for it.
Hmm.
Can they invest that $200 now?
If they've spent it, no.
Exactly. So that's what I mean. If you pay more than you need to for something, then you can't invest the money that you spent on that. So you can't
Mhm.
make money with it. The
For
money
sure. Like,
you would make you over the years on compound interest on that $200 is going to be way more effective than the $200 you just spent.
yeah, I hear you.
So I spent the 200, but I got some tires for it. Okay.
Mhm.
But if I didn't have to spend the $200 and I could invest it, compound interest is going to mean way more to me than me having to buy, than me being able to buy the tires. So that's what we're talking about. We're spending way more money than we need to on stuff. Therefore, we can also invest that money. That's called an opportunity cost problem.
Mhm.
Does that make sense?
No, makes a lot of sense for sure.
Do you have
I
something?
was, I
Go ahead.
well, there's the old saying, a dollar saved is a dollar earned,
Yes.
but you hear a lot all the time, right? Like it
Yes.
goes on a bumper sticker. But I must say I've never considered again the time value of money impact on that dollar saved,
Oh my
right? So
goodness. Oh my goodness. So
yeah,
you get that dollar saved. A dollar saved is a dollar earned. Now invest that dollar.
exactly. Okay, good point. I mean, you saved it,
Yeah,
right?
you
So you
saved
might as
it.
well, yeah.
But now you need to invest it.
You go ahead and save it, save it.
Yes, go ahead and save it. Save. Make that dollar work for you.
Yeah, yeah, yeah,
Okay. So yeah, no lazy money. I've
got it,
got it.
got
I like looking at it, but don't let it be lazy. Get it out there and get it working and making money babies. Okay. Oh, credit goddess, you came in just in time for us talking about money babies. How you doing this morning?
I'm good.
All
I'm
right, all right.
good.
So Mr. Aaron, do you have any other questions for us this morning while I get into, because here's one of the reason why I put this example on the screen this morning about getting a mortgage is because we're paying way too much money on the interest and we don't have to pay it, and we're taught to buy our houses very inefficiently. Okay, 80% of our money go into interest while only 20% of our money pays down the loan in the first years. Isn't that inefficient?
it. I must say, I've spent many hours recounting how mindless amortization is.
Okay. All right. So let me show you something here, and then we're going to talk about, once we have saved that money, how we can invest that money. Does that make sense?
For sure, for sure.
All right. So jump in anytime. We got Credit Goddess here helping us out. And so oh man, we got some comments coming in. All right, Tim Russell, can we just invest the money instead of paying down the low interest mortgage? Oh, Mr. Tim, I love that question because that's one of the things that we were talking about. Okay. So, Mr. Tim, when you work with your real estate, I was going to say real estate, with your financial planner, who however you are working with investing for the future, you need to get with a planner that says, all right, so how much money do you want to have when you retire? How much money do you want to have coming in after retirement? What is that number for you? What is that golden number for you? And then you work with somebody that's going to help you to get there. Okay. So if you're working with somebody that's going to help you to earn all the money you need to earn and invest where you need to invest, okay, then do that. We're not talking about disrupting your investment ideas at all. Invest what you need to invest to grow your money. But there's other monies that you have that we're talking about. So we're not just talking about making money. We're also talking about saving money. And what we're also talking about is not when we're talking about these low interest loans. A low interest loan, I need everybody to write this down and put it in the chat. Low interest loan does not mean low cost. Low interest does not mean low cost. It is a very high cost. In fact, as I'm paying down this mortgage of 3.625%, the bank wants 64% of what I borrowed. Here's what this means. If this loan was just $100,000, folks, I need you to see this screen. If this loan was just $100,000 over 30 years, the bank would want $64,178 interest on a $100,000 loan. How does 3.625 become 64%? Does this 3.625, folks, does that sound like low cost to you? If we have to pay 64% of what we borrowed in the form of interest, does that sound like low cost? Anybody?
Well, no, it doesn't.
Yeah, no, it doesn't. It's not low cost at all. So what if we could invest all the money we need to invest, but I can also cut my cost on this loan by about 75%? What if I could do both? Would that be a good idea?
This is interesting. So you're speaking about you said a 3.6%. Is that what you said?
3.625.
3.625. That's compounded versus
compounding interest is another thing. This is amortized interest. If I had a choice between amortized interest and compound interest, give me amortized interest all day. Banks make amortized interest in order for them to pay compound interest.
So it's my understanding that amortization just had to do with the distribution of the debt obligation, the interest obligation.
Well, that's what most people think. But what's really going on is how much money they make. It's designed throughout the entire loan. It's designed to make a ton of money throughout the entire loan. So if I put let me do this so we can, and I love the questions as we go along. Remember, folks, if we don't get to before you have to jump off, if we don't get to the very end, all right, we will get there by the end of the 2 hours. So you make sure that you know how to find us online so you can see the whole thing. So right now I'm putting on the screen, we're going to put on $322,000, right, at 3.25%. All right, and then boom. So we're going to put this over here on this screen here. We're going to cover this up, put it over here, and there we are. All right. So we got 322,000 at 3.25%. My payment is $1,401.36. Remember, I don't like escrowing. So you can put your taxes and insurance separately. Right now, we're going to get $322,000 home. We can buy it at $1,400 a month, which is in most areas way lower than the rent charged for a comparable house. Okay. I like that payment. But the bank wants, out of $322,000, the bank wants me to pay $182,000 in interest on this loan. $182,000. So is $182,489.60. Is that 3.25% of the 322? Actually, it is not 3.25%. The bank wants 56% of that in interest. It's over half. So on my very first payment, $529, goes to $529.28 goes to principal, while $872.08 goes to interest. I am buying. See, when you're making that, when you're paying on this mortgage, you're bringing your loan down by $529, which is your equity. All right. So this equity, I've got $529. I paid down the loan. My house is still worth what it's worth, but now I owe $529 less. That turns into equity. But what did it cost me? $872.08. Mr. Aaron, do you want to pay $872 for $529 worth of equity?
I want to say no. I just don't know of anything different. Any financial product in the market that exists differently.
Well, we're going to use this financial product to make a lot of money. You don't need a new product. We just need a new understanding.
Okay.
So,
Okay.
are you able?
New understanding of the conventional
Yes,
mortgage product.
Exactly.
Okay.
Because the Fox has told us how to use this product. Does that make sense?
I don't know who the Fox is.
The Fox is the bank.
Okay.
They've taught us how to use it.
Very interesting.
They're in charge of our education. Okay? So we do not have to pay this interest. So I want to show you something. In cumulative principal and cumulative interest, after 1 year, we will pay this loan down by $6,446.79, but it will cost us $10,369.53 in interest to do it. Do you want to pay 10 grand just to get $6,400 worth of equity?
If I don't have to, of course not.
If there's a way to do it and pay less, would you want to know?
Well, here it is again.
Yeah.
You said, I heard you say, there's a about the 3.62. I think you're talking about the loan. You said it's a difference between a low interest loan and a low cost loan.
Right.
Again, you went somewhere that I wasn't expecting. Talking about the amortization. I thought you were going to talk. You were mentioning the points that a financier would require upfront, or the fees associated with origination.
Yes.
So I had no idea. So when you asked, would I want to save? Okay, well, what are the fees, origination costs, and points upfront on coming to know how to do this?
Now, we're not talking about that at all. We're talking about making your best deal you can on the loan, and then not paying all the interest the bank is requiring of you. You do not have to pay all that interest at all. And I just changed the interest rate to 3.625, which means our payment is actually $1,468.49. And the bank wants on $322,000, they want me to pay $206,000 worth of interest. That is 64% of what I borrowed, 64.179%. So my very first payment, $495.78. Mr. Aaron, can you see this example? Are you watching it on a different screen?
No, sir. I'm only in the clubhouse room. Where's this shared screen?
Yeah, if you want to go to, if you're near your computer or a tablet, you can go and watch this on our YouTube channel.
Oh, great.
Yeah.
Is this the link for the YouTube channel above, or?
Well, you can go to, I'll give it to you. It's ice10k, ice10kvideos.com, or you can just go to YouTube and search P.I.L.L Method. Either way, ice10kvideos.com.
All right, I'm on my way.
All right, and let us know when you get there. So, folks, here's what we're talking about. We want to make sure that you understand how all of this is set up, so that while just living life, we learn how to spend more money than we need to spend. Therefore, we're using our money inefficiently. Therefore, somebody's getting rich. Credit Goddess, are you available to speak with us this morning?
I am.
Would you please introduce yourself while Mr. Aaron is getting set up?
Sure. Hey everyone, my name is Rose Laura Lewis. I'm also known as Credit Goddess, all things credit, and the official credit expert for the Pill Method crew here. If you are not following his club, definitely tap on Don's picture, scroll to the bottom, and you'll see the club called the Pill Method. Join that club. We're here on the Mortgage Syndicate group because we want to be able to share this information in different clubs because this is one of the things that a lot of people um, wondering, like, why am I paying so much? And Don is actually showing you how to save on interest costs over time. Now, myself, I'm the key to accessing other people's money. Definitely, you want to be in the best position to gain access to other people's money and also get the best rate and the best term. So if any of you guys are credit challenged and or if you guys are seeing this economy or the housing market, the homes are being so high and you're worrying about interest costs, I want you guys to ask Don, how do I save more money with higher interest? Because that there, you guys need to understand. So once you understand this, then you will be able to put a plan together on how to pay off that mortgage in 7 years instead of 30, right? So if any of you guys are credit challenged and this whole ordeal was holding you back, definitely tap in with me. The numbers in my bio. Send your name and email address to 888-557-5778. A link will be sent to you where you can book your consultation with me. And let me take a look at your credit report and tell you exactly what it is that you need to do to improve it. So thank you so much, Don. I'll be here to answer any questions. And if you want me to break down how amortization schedule, calculator, and all that good stuff work, I'm here.
Thank you so much for that, Credit Goddess. Listen, folks, she was on here with us on Friday. She did a whole hour. She did a whole hour of just helping to understand how to get in the credit game so that you can learn how to utilize somebody else's money to make more money. Go back to Friday's episode and listen to all of that, and how to get a hold of her is on there as well. And I'm telling you, it's going to be fabulous. It was a fabulous show. Thank you for that.
It was. You're welcome.
All right. So, Mr. Aaron, are you ready?
So yes, I'm on it. I was trying to make sure I didn't get feedback. I'll pause the video. It's just I think it's a
Yeah,
slight delay, but
yeah,
I'll mute
it's a
and give
slight
it up.
yeah, it's a slight delay. So mute that so we can talk.
For
So
sure.
yeah, so you don't want to pause it because then we'll be really behind.
Okay. For sure. Exactly.
Yes. So now you should be able to see. So if you paused it, you won't catch up. So you need to end the video and come back in, and then you'll only have the regular delay.
Okay. So here's a piece. I actually don't see the option to turn the audio down because I am on my phone.
Okay,
Oh, here it is. Okay.
you got it.
Hello? Yep, just did. Okay.
All right, good. So now I need you to see. All right, so here's what we're talking about. Here is a $322,000 loan, and I'm going to, so that I don't speak ahead of us, I am going to go on YouTube myself, so I will be able to see where we are on all of this. Go to my channel and go to the live. There we are. And wait till it counts down. Then I could bypass the commercial. There we go. Now I'm on with you. So I'm watching what you're watching. All right. So now we're at 322,000. That's 6.25%. Here's the payment, 1468.49. And here what the bank wants, $206,000 interest on $322,000 in principal. That is a lot of money.
Yes, it is.
Okay. All right. So I'm scrolling down further. Why is this paused? So, oh man, I paused it myself. Dang it. Sorry about that, folks. I messed up my own video. Can you believe that? So let's do this. Let's get out of it. Start it all over again and not pause it this time. There we go. Now I'm back in. All right, so here we go. So let me scroll back up here so people can see this. So 322,000, and the bank wants $206,000 in interest. If we look over to the right, that means they want 64% of what we borrowed in the form of interest. 64%. So 3.625 is not cheap interest. It's very expensive. So we've got $495 going to principal, $972.71 going to interest. I think that's a lot of money to pay in interest. So if we brought our calculator up and put it on here and say, okay, here's my interest cost. Okay. $972.71. And my payment is, so I'm going to divide it by my payment, which is $1468.49.
It's about 66%.
66%. 66% of my payment is going up in smoke. Isn't that crazy?
Well, that's insane.
66%.
That's a lot.
So they're making a ton of money off this thing. So here's what we're talking about, folks. If we can do, if that's what's happening, now we're going to learn how to read it. Okay. We're going to show you how to save money at the same rate they're charging you, Aaron. How would you like that?
It'd be nice.
Okay.
Sure.
So we've got 490, very first payment. Let's call it January. We've made our payment. 495 went to principal, paid down our loan to the principal balance on line 1, which is $321,504.22, and the interest cost was $972. So if this is January's payment, we can also see February's principal payment, can't we?
Yeah.
Okay. February's principal payment is how much money?
Let's see. Principal payment 49728. Am I reading the right line? 497.28.
Okay, that's February's principal payment. Let me ask you, do I have to wait till February to give the bank that money?
No, you do not.
If I had it, could I give it to them in January?
Yes, you could.
If
as a part of your down payment, even.
Yeah. Well, listen, I don't do down payments. That's another thing. Remind me to talk about that if you want. But if I do the $497,28. If I choose to prepay that, give it to the bank in January, then I'm paid down to line 2 in January, because all of that money will go to principal, wouldn't it?
Yeah.
Okay. So that means my next mortgage payment, if I'm already paid down to line 2, my next mortgage payment for February is actually on what line of this schedule?
Your next payment after February? What are you saying now?
Right. So I'm in January. My next payment for February is on what line of the schedule then, if I'm already paid down to line 2?
Yeah, I don't think I understand.
Okay.
The question.
All right. So we're making payment 1, 2, 3, 4, 5. Do you see the payments on the left side?
Well, yeah. Yes, for sure.
All right. So I'm already down to line 2.
That's right. You paid that money up front.
Right. So now I'm still in January.
Yeah.
So I still have to make a payment on February, right?
Well,
yeah,
I mean,
I do.
It depends. Do you tell the bank? Do you tell the bank?
No, don't get deep in the weeds right now.
Okay. All right. Okay.
The money went to principal.
Okay, for sure. Okay, great.
All right. We went to principal.
So you still have to. You have to pay for February still. Then
right.
You went to principal.
All right.
That would be your payment number 3.
Payment number 3. So we're on line 3 now. This is our new February payment, right? Guess what just happened? We got rid of line 2. We got rid of line 2 for not $1,468 that they wanted. We got rid of line 2 for only $497.28. Line 2 is gone. So we just changed 360 payments into 359 monthly payments just by giving the $497.28 early. Now, the $971.21 on line 2 for interest, what happened to that?
The 49, they said the 49878 or 49720.
The interest payment.
Oh, I see. Oh, yeah, the 97121.
What happened to that?
Well, so this is an interesting question.
Yes.
So you're not paying. You're paying. So you paid an amount, 497 early, 497.28 early, and so now your interest for the previous lapse, 1 month lapse in time will be calculated based on a new principal.
Exactly.
Total. Yeah.
So the 97.21 is calculated on the first principal balance of 321,504. But bank didn't even see that. So what happened to the 971.21? Because we know how much interest we're paying on line 3.
Yeah.
So what happened to the 971.21 on line 2? Take a guess.
I feel like there's an answer that I might be prompted to give.
Yeah,
I just
but
don't
give
know
it.
if that's the truth though.
Listen, this is a safe space. Give it.
It's a safe space.
Yeah.
All right. Without having put a pencil on a piece of paper, let me tell you something. As a math dude, I'm not that good.
That's okay.
As a mathematician, engineer, I'm not that good. But I want to say it's disappeared, but I don't know
It
if
has.
that to be the case.
It has.
I hear you.
You have saved $971.21 you never have to pay. You see, this equity, this $497.28, how much did that cost me to get? $0. When the bank wants to charge me $971.21 to get this equity, I got it for nothing.
Yeah.
$0. So what would happen? What would happen if we did line? So we made January's payment. What if we had some money saved up, a little money saved up, and we gave them the principal balance? The principal payment for line 2, 3, and 4. A little less than $1,500. What would happen to the interest payments on line 2, 3, and 4? So we don't have to pay all that interest now, do we?
Yeah. And when I see how this is most advantageous as early as possible.
Yes. It's most advantageous as early as possible because the higher interest costs are the cheapest to get rid of.
Yeah. That's a nice way to say that. Yeah.
Okay. So understanding how the bank has built this thing, we can now not follow their rules or their conditioning on how to pay this loan off inefficiently. We can become more efficient with our money. So now let's look at line 12. And this is what I'm talking about with what I'm saying. We can get this for a lot less money. Now, we are purchasing equity, aren't we? Do you understand that part where we're purchasing equity with the interest we're paying?
For sure, and it's an appreciable asset too. I like doing this in the car.
Come on, Aaron,
Yeah.
talk the talk, boy.
Yeah.
Okay.
Yeah. I see what you
so
mean.
we're buying the equity, and most people don't look at it as purchasing equity. I need everybody to learn how to see it this way. When you get a loan on your home and you're purchasing equity, every time you make a payment, the interest is the money you pay to purchase that pay down, which is the equity you just created. So
but you're just paying yourself though in that case.
Yes, but when I pay myself, do I want to pay more money to pay myself or less money to pay myself?
Do you want to have to pay 3 to 1?
Come on, boy. Come on. That's what we're talking about. Okay.
That's some crazy stuff.
All right. So listen, on line 12, take a look at cumulative principal and cumulative interest, will you please?
Okay.
Line 12. So cumulative principal, how long? In 12 months, we will pay this loan down by how much money?
Cumulative interest.
Cumulative
you'll
principal.
pay it down by the cumulative principal,
right?
Is $6,049.23.
And how much money does the bank want in 1 year to do that?
They almost 12 grand.
Almost 12 grand. So should it have to cost 12 grand to buy $6,000 worth of equity?
I mean, we all know that mortgage bankers are some of the most evil people.
They're not evil. I really like them. I really like the bank. I love the bank. Do you know why?
Why is that?
Because I know how to get my money at a discount. They've got a resource that I need. I don't pay cash for anything. I use their money, but I don't pay them all the interest they're looking for. You like that?
So, yeah, for sure. So of course, this is all, and just, I'm really looking to get some perspective perhaps on, is this not all based upon the availability of a store of cash?
And no,
I mean, it's not a big store.
I understand. I understand what you're saying, but remember, I kept asking if you have it available.
If I got you, for sure. And of course, most people are going to have 500 available.
Right. And I just said, if you have it available. So I'm qualifying it. I'm not telling you my methodology here. I'm just helping you to understand what the bank is doing to you.
Yeah, for sure.
And how we can disrupt their timing. So I'm just giving you some information on how to disrupt what they're doing. I'm not giving any prescriptions here. Like Credit Goddess says, we need to have a proper diagnosis. Okay.
So here's what would be nice, just off the top of my head,
sir.
Yeah. What? Because I still have the monthly obligation, right? Irrespective of whether or not I'm making that principal payment, as early on in life as possible.
Right.
The question is, how can you tap into that value? I mean, because it's the house is for many people.
Yeah.
The home is a necessary asset. I have to occupy it and not be making money off of it. You see where I'm going? Like, it's I want to be able to tap that bank to address the issues with my relationship with the mortgage.
You're right. You're right. Can I ask you?
So I want my cake and eat it too. Is really what I'm trying to say.
I love it. I love it. Can I ask you a question?
What's going on?
Where do you live? May I ask what you do for a living? May I?
I'm a project engineer, and I'm also an entrepreneur.
You're a
licensed residential contractor.
All right. So you're a project engineer. All right. So I want to know more about what you do and how to do it well. Okay. And I need you to, over the next hour, teach me how to do what you do well. Can you do that?
Likely not.
Likely not. So I have to learn the basics of what you do even before I can start to understand how to do it better. Correct?
For sure.
That's what I'm doing now. I'm showing you the basics, and then we can get into the better. Are you ready?
I'm listening.
All right. All right. So now if I'm going to keep this house, I have to give the bank at least at some point in time, $6,049.23. Right?
That's be it by the end of the 12 months.
It doesn't matter. I have to give it to him at some point, don't I?
Yeah.
Because that's money I borrowed. Correct?
That is correct.
Correct. Okay. I guarantee you there's no trick questions here. All right.
You gotta make, so look, this is okay. No, I'm listening.
Okay. So we got to give the bank that money that we borrowed. So here's my question. That $6,049.23, do I have to give it to them in 12 monthly installments?
No.
No. If I had it, could I give it to them all at one time?
Yes, and you could have gave it to them with your down payment.
Right. But remember, what do I say about down payments?
You said you don't like down
I
payments.
don't like down payments. Don't do it. And I'll tell you why in a minute. Okay.
Okay.
All right. So now, if I give this to them now, all right, if I give this to them now, I'm paid down to line 12 in 1 month, aren't I? Well, let's do the
Yeah.
math.
Well, I mean, you're paid down as so far as what your principal obligation would be. You still have the monthly obligation.
Well, see, you're getting way too far in the weeds. You're answering more questions than I'm asking.
I mean,
Okay.
I'm a mathematician.
I know, but if by answering my question does not negate all the other truths that are out there. Do you see what I'm saying?
No, for sure.
Okay.
Yeah, no, for sure. For certain.
All right.
For certain.
All right. Okay. So
Okay. I'm gonna be cooperative because I'm trying to learn.
Thank you, sir. Thank you. All right. So if we pay this down, we're paid down to here in 1 month, aren't we?
If we pay this down, we're paid down to 12. Sure.
Right. Okay. And what happened to all the interest payments between line 2 and line 12? What happened to those?
That's recoverable value at the end of my.
And tell the people what recoverable value means.
Huh?
Tell the people what recoverable value means.
Well, I mean, I don't think it's a term that you'll find in financing. It's just a convenient nomenclature I pulled out of nowhere to describe.
That's money you didn't have to pay.
Yeah, for sure.
That's money you did not have to pay. So here's what happens, sir. Here's what's going on. I can either do it the bank's way, and I can purchase my equity of $6,049.23 and purchase it for $11,572.65. Or I can purchase this equity for $972.71, the interest on line 1.
Yeah.
If I'm going to purchase it, why not purchase it at a $10,616.67 discount? And if I give this to them in January, and I'm paid down to here in January, my February mortgage payment is on what line of the schedule, sir?
January, February was on. If you do the 12-month, you're saying?
Mm-hmm. If I give them the $6,000 all at once.
Oh, I mean, your February payment's down at 13, huh?
Exactly. So we have a payment every single month, but I just have a lot fewer of them. And I'm purchasing my equity at a much lower cost.
Okay.
Does that make sense?
Yes, it does. I have a reasonably vital question.
Go right ahead.
In your mind, and with your expertise and your experience,
yes,
what is the value that one captures in employing a methodology in this school of thought as opposed to just paying more of a down payment?
Okay.
Outside of the down payment is only a one-time thing.
Well, let's talk about it. Okay. I got $322,000. Okay. I could have put a down payment down. All right. So I'm going to let's see, get a new, and we're going to duplicate this tab. Okay. So I've got $322,000 here. And how much do you want to pay down on this? And you're going to need a calculator because you brought this up.
Okay, all right. I have a calculator on my phone.
Let's
say a nice nominal 10%.
Okay. What, $32,000?
Yeah, sure. Move the decimal place.
Okay. All right. Let's do 32. Let's do 300. Let's do 32,000 to just to make it round. Okay. All right. So I'm gonna pull up my calculator. All right. And we're going to put in $32,000. We got $322,000. This is for everybody to see. And we're going to subtract 32,000 from it. And so now I have a mortgage of $290,000, correct?
Yes, yes.
Okay. So 300, okay, 290,000. All right, same interest rate. Okay. And now here's what I got. $290,000, 3.625. All right. And this is where I want to start out. I want to start out because I put that money down. 32,000. So now let's do the math. I have a payment of 1468.49 the other way. All right, by not putting the money down. And I have a new payment of 1322.55. So I'm saving money here.
Yeah.
All right. 1460
But it's
1460.
slow. It ain't much for how much you had to put down.
Yeah, it isn't, is it? All right. So let's take a look at the interest cost for 30 years. Now remember how the banks share this information with you is they give you the difference between two 30-year loans. My average client is paid off in 7 years. So these 30-year numbers don't even apply. Does that make sense?
Yeah.
But here's how they sell it. If you put your $32,000 down, your total interest cost for 30 years is $186,000 versus $206,000. So people, if they have that money, they're going to put that $32,000 down, aren't they?
If they have it, yeah, perhaps so, yeah.
Yeah, well, obviously they have it because you brought it up.
Yeah, for sure. Yeah.
Okay. Okay. So now
Wait, I don't want to misrepresent. I just picked a nice, easy number.
That's okay. So I'm saying, no, you want the $322,000. I don't want to put that money down. So if I take this loan, the $322,000 loan, where's my $32,000?
It's in my pocket.
It's in my pocket. So what is the difference between, we're going to put that on the screen, folks. So the interest the bank wants on the first loan is $206,656. Okay.
Or should I say it's in my account?
Yeah. 206,656.
Yeah.
And then I can subtract $186 from it, $186,000 from it. So we're going to subtract $186,118 from that. So over the life of the loan, I could save $20,538, but I have to keep it for the entire 30 years to realize that savings. Because these are two 30-year numbers, correct?
Yeah.
So $20,000, that's nothing to sneeze at.
For sure.
Okay.
Yeah.
But I'm saying take this loan, the $322,000, and my $32,000 is still in the bank, isn't it?
Wait a minute, hold on. You can't be about to say what I think you're gonna say. What?
What am I getting ready to say, brother? What am I getting ready to say?
Okay, so wait, you said no way in hell. Wait a minute. So you said $206,000.
Yeah.
Right? That was the I forget the term they call it, but that's the cost of the finance charge.
Right.
Was without the down payment.
Right.
Was $206,000.
Right.
Correct?
Yeah.
And then if I paid the $32,000 down up front at times zero,
you're
saying my total finance charge was about 180. Is that
186?
Which would be a $20,000 savings.
Yes,
but that's not nearly the amount of savings as. But hold on, sir. No, because that doesn't make sense. I'm trying to figure numeric. I need the formulas. What are the formulas? Because no. I'm very upset right now. I really am. You're laughing at me. Listen, here's my question. Where is the savings being consumed then?
Okay. Okay. Now remember, we're purchasing equity, and this is going to help other people, not only you but everybody out there. We're purchasing equity with that money. Every time I give them money, I'm purchasing equity.
What is the difference?
Well, let's see it.
What is the difference in the mechanism of a down payment and the mechanism of payments as it relates to your amortization.
So
That's what I'm trying to see.
we're doing the difference between a prepayment and a down payment. Never do a down payment, do a prepayment. Establish the loan. And if you want, now this is not something I would necessarily recommend, but if you wanted to, if you were going to put that $32,000 down anyway, okay. Now, when you start out, when you put your $32,000 as a down payment, you start out on payment number 1, don't you?
Yes.
But if you get the entire loan of $322,000 and put $32,000 down, look what happens. I'm scrolling. I'm putting it as a prepayment, $32,000. I start out on payment number 65 on my amortization schedule. I just knocked off 5 years off a 30-year loan.
So you're looking in the cumulative principal column until it hits 32, and that gets you to payment number 65.
That's 5 years.
5.5 years in the future.
Yes.
So wait a minute. So what is the corresponding cumulative interest?
Oh, $53,000.
So why would they do that though? Is the bank assuming that you're going to pay down as much as you can afford?
The bank is assuming that you don't know how to read an amortization schedule, so you're going to give us the down payment instead of a prepayment.
Wow.
Because they're not going to give you that information.
Damn.
And everybody's doing it that can afford to do it. Instead of starting out on payment number 1, now I've just knocked off. I'm still at the same place.
Yeah.
But yeah, I'm 5 years in.
Yeah.
Does that make sense? So instead of saving $20,000 over 30 years, I just saved $53,000 in 1 month. I just purchased $32,000 worth of equity for $876.04 instead of the $53,000 the bank wanted. I'm still purchasing equity, but what are you paying for your equity, sir? That's the question here.
Yeah, I get it.
I want to thank you for coming to the stage.
Oh, I want to thank you for blessing me with that gift. I've never considered, you see, prepayment versus down payment. Now you're gonna have me on a pencil and paper.
Well, listen, if you want to use pencil or paper, you can. But guess what? You don't have to, because our company wrote we have an artificially intelligent cloud-based computing platform that does all of the math for you and gives you individualized information. And here's I want you guys, before you get off, I need you to hear something that somebody else who used our system, all right, to pay off their mortgage in 4 years. Have you ever heard of E.T., the hip hop preacher, Eric Thomas?
No, sir.
Eric Thomas is the #1 motivational speaker in the entire world.
Wow.
Okay, so look him up. You're gonna love him. When you Google his name on YouTube, I mean, he's all over the place. So follow him on YouTube, follow him on Instagram. But here's what Eric Thomas had to say about this program. Play it, please. My name is Don Daniel, founder of P.I.L.L Method International, and our team created the most powerful money management, wealth building, debt elimination system ever created. At our recent seminar in Nashville, Tennessee, the keynote speech was delivered by the #1 motivational speaker in the world, Dr. Eric Thomas. E.T., as he's also known, mentioned he paid off his mortgage in 4 years using the P.I.L.L Method. I invite you to watch and listen.
Listen to me, y'all. Well, one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse, just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? that thing that was coming every month that was getting on her nerves, we didn't have that no more. And so she was at rest.
Did you hear that? No mortgage, no stress. If you would like to become debt and mortgage free within an average of 7 to 9 years by cutting your interest costs by up to 75%, go to PILLmethod.com and request a savings and earnings report today. There you go, sir. Listen, Aaron, you mentioned a little while ago, what if you don't have the extra money? Here's what we do. We take a look at your entire budget. And number one, in your budget, we want to make sure you're living well. We want to have a great lifestyle. That's number one. Number two, somebody else mentioned you need to be putting money away in savings. Work with your financial counselor so that you're putting enough in savings to hit that magic retirement number for you, and don't let anybody touch that, not even us. Okay. Number three, you want to make sure that you're at least paying the minimum payment on the debt. Okay. You're making the minimum payment on your debt. Number four, you want to make sure all the rest of your bills are paid. When you cover those four things, there's going to be some money left over. That's called discretionary money, discretionary spending. Our program is going to ask you to put that money in savings and hold on to it. Okay. Because you already have your major savings for retirement. This is discretionary spending that you can spend any way you want because it's outside of the budget now. Put that in savings. Our program will say when to tap that money that's in savings and how much to apply to the debt, which debt to apply it to, what month to do it in, what day of the month to do it on, so that we can optimize your interest savings per dollar. That's what our computer does for you, so that you can optimize your interest savings. Or, Aaron, you can take your pencil and paper and try to work it out for yourself and do all the calculations.
No, I hear you. It's not too easy by hand. I was being facetious. It's certainly a calculator.
That's what we're doing, folks. And so when you have all of these variables, okay, when you have just 5 variables to consider, that's 120 different ways you can look at your money. One of them is optimum. When you have 10 variables to consider, and even one loan, and we can point these out to you, has at least 10 variables. That's just one loan. The average family has 13 different debts. So if you have 10 variables, that's 3.68 million different ways to look at your finances and how to manage them. And only one of those is optimum. And that's just enough to make one move in 1 month. So our program does
like 10 factorial.
Listen. Here he goes with man. Don't be stealing my thunder. That's exactly it. That's 10 factorial. All right. So when he says he's a math guy, he's a math guy. That's 10 factorial. So we are exponentially expanding the number of permutations that are out there. What do we have to do? How do we line these things up to save the most amount? And he, being an engineer, he also knows you can't optimize what you cannot measure. Is that right, Aaron?
Yes, sir. 100%.
And we give you the measurements that the bank has never taught you how to measure. This is where we come in. I want to thank you very much for coming in and making it clear to a lot of you. Helped a lot of people today. And this is going to be up on YouTube permanently. It's going to be on Facebook permanently. And now we're going to talk about how important it is to keep from giving the bank in just one move here, $50,000 they did not need. Oh my gosh. So when we're talking about saving money, now, if you don't have to pay that money, if you don't have to pay the $50,000 to get the $32,000 in equity, that means if you're conscientious, you can invest that money. Is that right, Mr. Aaron?
Yes, sir.
It was money you were going to spend anyway.
For sure.
Okay. So here's where we are. I'm going to go back to our original example here, and you see it on the screen where Here we go. Here we go. We have
It's realized so much earlier, though, too. That's the beat.
So we are looking at what the bank wanted to charge in just 60 months to get $27,000 worth of pay down on your loan. They wanted to charge $46,000. And here's what we're pointing out. From this point on, the bank wants $190,000 in interest to pay off your loans. Way too much money. Here's what we're saying. Instead of giving them $190,000 to pay off $322,000, why don't we just give them $71,000? Why don't you just pay out $71,000? Pay it off in 9.9 years. That's $125,000 in interest saved. Take the money you're no longer paying to the bank, and over the next 20 years, turn it into $868,000. Oh, well, that's what we're talking about, Mr. Aaron. Become your own bank using monies that you would have paid in interest and turn it into another. And this is on top of what you're already doing to set yourself up for retirement. This is found money, recovered money that you would have spent anyway to acquire the same asset. Now I can acquire the same asset for $125,000 less. Now I can invest that money. Whew, Darlene said that is something to be. Darlene, you need to come up to the stage. Just don't be putting your emojis on there. You need to come up to the stage. All right. My. Who else wants to come up? So I see some hands going up. Okay, there we go. I see. Come on up, Miss Sherry. Anybody else need to come up? I need you guys to figure out. See, if you're an insurance agent and you're in the audience, please come up, because we're going to get into how to, with that money, how to establish a bank, your own bank with that money. Miss Cherie, is that how we pronounce your name?
It's Sherry. I'm not an insurance agent.
Hi, Sherry.
I want to say I've heard you present this a few times, and it was beautiful how it was broken down to Mr. Aaron, specifically since he's already a very intelligent man. And I know that he said he may go home and try to calculate it himself. So I didn't know if he was going to bring it up. But your other client who was trying to double up on payments, if you could show him how doubling up on the payments won't work in his favor either, I think that'll be great, because this is an amazing opportunity of information that you're presenting.
Thank you, Miss Sherry. Listen, you just hang out on the stage. You got anything else to say, you just say that. So listen, folks, we're just building this thing out. We're building it out so that you can see. I'm trying to introduce as many aspects of understanding our money so that when we look at different ways that we can keep adding on money saved here, money saved when we don't make a down payment, money saved when we're optimizing our interest savings by paying the right amount at the right time. We're adding that on. We're understanding what the bank is doing to us. We're understanding how not to, we can understand when to refinance and when not to refinance. All of this has to do with how much does it cost you to manage the money? How much does it cost you to purchase your equity? So we're looking at as many different ways as we possibly can with our program. I mean, there's a ton of different ways. I just don't have time to go into it for you today, but we're looking at a ton of different ways. How do we look at all of those ways simultaneously and give you a few instructions on how to follow everything? You want to get an opportunity cost calculator that's going to help you. You need to, first of all, get a savings and earnings report. If you see the oh, there's Flame. Let's invite some other folks up here to speak. All right. If you want to learn how to do all of this stuff, get a savings and earnings report. Go to the link above, click that link, and click on get a savings and earnings report. You can know the month, day, and year. I mean, what you see here on the screen, every single one of our clients has to receive one of these. And I even have people ask me, Don, are you saying if I gave you 3 times your usual fees that I would normally pay if I had filled one of these out. You mean you won't let me become part of your program without me getting this first? Absolutely not. You need to know exactly what you're going to be saving, what you're going to be and the month, day, and year you're going to be debt free. And let's see if we can help meet your goals. We have to find out what your goals are. So that is why you can't go to my website and purchase the program. We make sure each one of our clients is going to be successful before they become part of the P.I.L.L Method family. And folks, if you Google P.I.L.L Method right now, here's what you're going to find. You will find, do you know how bad information is out there practically on every company and never goes away? You will not find one negative word about this program from anybody who has ever used the program. You'll find some haters out there that have not used the program, but you won't find one negative word from anybody who's ever used the program. We have an A+ rating on Better Business Bureau for the last 16 years, and no complaints on Better Business Bureau. None, 0 complaints. There's not a whole lot of companies that can say that, folks, because we make sure before somebody becomes a client that we do this for them so that they can understand what their benefits are going to be. And then we guarantee these benefits, because if we do not match this or do better than this, there is a lifetime money back guarantee. And if you're on Clubhouse, and there's a lot of courses out there with people who do business, there's nobody out there that's going to give you a lifetime guarantee on anything, but we will. We either do what we say or you don't pay. You need to make a t-shirt out of that. We either do what we say or you don't pay. Get your savings and earnings report today, folks. So we got some new people in the room. Flame, what's up, my brother? Listen, I'm going to make sure that he gets an opportunity to share with you folks, because he was doing another room just a little while ago, and he finished up over there, and he's bringing all of his people over to here. So I just want to know if Flame, are you ready to introduce yourself?
Listen, first off and foremost, man, listen. If y'all down with Don the P.I.L.L, man, let me see number 9 in the chat. Listen. I care less about anything else that you got going on in the world. I said, if you down with Don the P.I.L.L man, let me see the number 9 in the chat. All that I'm trying to get down with him. I want to be down with him. I didn't say none of that. What I did say was, if you down with him, let me see the number 9 in the chat. What I understand is Brett down with Don the P.I.L.L man. Marshall down with Don the P.I.L.L man. KP down with Don the P.I.L.L man. Oh, man. EJ's down with Don the P.I.L.L man. Listen, this is what I'm here for. I'm here for Don the P.I.L.L man. If you down with Don the P.I.L.L man, let me see that number 9 in the chat. We ain't about to be sitting around here playing none of these goofy games or what we trying to do or how we trying to get there. We're going to say the game how it is, and that's fair. If you down with Don the P.I.L.L man, let me see the number 9 in the chat. Oh, Jamie put it. Arthur put it. Oh, man, this is what we do it for. Smooth Rich Dude. That's the best name on the app. I ain't never met a guy named Smooth Rich Dude. I met Smooth Rich Dudes, but not a guy that called himself Smooth Rich Dude. But with that being said, other than that, Mr. Don, I'm going to give it right back to you, because these number 9s is in the chat.
All right, so we got 25 shares in the room. Now, folks, we're just kind of laid the groundwork for this thing. All right. So because if you're going to start a bank, if you're going to start your family bank, you got to have some money to start it with. Huh? Okay.
No. I bet you don't start no room. Hey, listen, Mr. Don, what I need you to do is go to the bathroom, get a drink of water.
Okay.
These are 2 things that you ain't gonna do. One is you ain't gonna talk. You will not utter another word out of your mouth until we got 50 shares in this room. You said it's only 20. You said it's 25 shares. I know what you dropped when it's just me and you. And you told me, this is what you told me. You said, Flame, whatever I give you 50% of what I actually give the people.
So if he gave me what he did to me, changed my life. If he gave me 50% of that, what I'm telling you guys is that there's 25 shares to the room. I need to have 50 shares. I need 21 more shares. Can I get 20 more shares? I need 21 more shares. Hey, listen, Mr. Don can't say another word. Don't encourage him. Don't go to the back channel. Don't talk loud. No, we ain't doing none of that goofy stuff. What we're going to do is share the room. We got 35 shares. I need 15 more shares to the room. Listen, bro, we're not about to do all of that. No. Don't back channel me telling me about how much he changed your life. You share the room. That changes somebody else's life. I need 11 more shares to the room. Listen, we're not playing none of them goofy games. I need 11 more shares to the room. I didn't think it. I said it. So somebody here want to right now say, well, Flame said this and Flame said that. No, Flame didn't say none of that. Flame said share the room. I need 2 more shares. Give me the 50 shares in this room. When I came in this room, it was 17 shares. There we go, Mr. Don. 50 shares.
All right. Thank you. Flame. Listen, folks, here's what we're going to talk about. We took the time to set this thing up to show you that we're spending more money being taught the way that we've been taught to handle our money. We're spending more money than we need to spend. And what we're talking about is how to preserve and conserve our money to invest. You still want to buy a nice house? You can. You just don't need to pay all that interest to get it. You still can use student loans to get your education, but you don't have to have those student loans forever. My average client pays off their student loans in 5 to 7 years. Because we're not paying all of that interest. You don't have to. You can get the car you want. You can drive what you want. You can go anywhere. You can vacation where you want. We're going to show you how to live well. And where we're going to cut back? On the amount of interest you pay. And then we're going to take that money and invest it in building wealth. At the same time, you're paying off your debt. So here's a situation where we had an individual who's going to be able to pay off their house, and not in 30 years, but in 8 years. But at the same time, they're investing over and above what they're putting into their retirement account. They're also building their own bank. So here's what we're saying. Paying off their house in 8 years. Okay. They're already contributing to their retirement fund so they can hit their magic number when they retire. And they're building their own bank with some of that other discretionary money, because there's a point at which, folks, more is too much. One other thing you're going to learn is the law of diminished return. See, you want to save as much money as you possibly can in interest with the smallest amount of money available, not the largest amount, the smallest amount. Once you put any more money than that into debt reduction, you're wasting your money. Find out where that magic number is, and our computers do all of that math. Find out where that magic number is to eliminate that debt and save the maximum amount of interest that's mathematically possible. So you're saving the most interest per dollar, and then at that point, take the rest of the money and start building more of a nest egg for yourself. We're going to take that money to become your own bank. So now that we've set this up, we have a few minutes left. We're going to put this on the screen, folks. Let me pull it up. There you go. Come on. Where did it go? I need it back. All right. There it is. Here's our illustration. Okay. Young person at the age of 26 years old, we're using a tool called an IUL. It is an index universal life insurance policy. It is a form of whole life. All right. So we have Mr. Travis there. Before I get into this, Mr. Travis, I don't want to ignore you here, but please introduce yourself so that the people can get to this, so we can show them how to become their own bank. Mr. Travis, talk to us this morning. Are you available? Travis Davis. All right.
Hey, what's going on?
Hey.
What's going on, brother? My bad.
That's okay, man. That's okay. Tell us who you are, man. And what is that brought you to our stage this morning?
What's going on, Dr. Travis Davis here from the DMV area. Specialize in government contracting. Try to teach my community how I was able to get involved in an industry that is recession-proof, inflation-proof, whatever you want to call it. They're the largest customer in the world. They spend the most money every year, over $3.54 trillion they spend with our tax-paying dollars. 23% of that has to come to minority-owned businesses. And only 1.67% of the Black community is obtaining government contracts, mainly because we're not showing up. We don't know about it. We often have the wrong definition of government. We have an emotional definition to it, one that I really don't care about. The government's never done anything to change my life, but they do have access to these contracts that can change your life. And this credit, you're going to need the credit. You're going to need the money to do these $1 million contracts, to pay your employees on payroll, to go purchase the products for the government, because they're not about to pay you to run a business. So people often ask, can the government pay me to buy a product? Why the hell would they pay you to run your business? So you need to be able to go get the money first, then go purchase the products and or pay your payroll, and you'll get reimbursed on the back end. But without good credit and things of that nature, none of this stuff will work. So it's very important that my community learns about credit, because I'm not the credit master. I just know how to go get the money. Never had. I really don't know anything about credit. I'm not even but y'all do. So I bring the subject matter experts. Y'all do.
Yeah, so Travis.
All right, man. Thank you so much, Travis. We appreciate you, man. All right.
They moved it up to 30% now, Travis. My Black folks could get 30% of the contracts. Plus, it's actually from $500 billion. It's actually up to $745 billion in government subsidies right now, Travis.
Wow. You heard it, folks. Listen, I need you to tap in with these folks and see how you can get a piece of that. So let's go ahead. This is what you came in here for. We took all that time to set this up. Now let's take a look at how this individual is not only paying off their house in 8 years, not only already putting money towards their retirement program, but also building their own bank at the same time, using what's called an IUL, Index Universal Life. As you can see here, this is called an illustration. And with an illustration, it means this. This is just a projection. Okay. These numbers aren't guaranteed, but we're looking at a historical view of how the insurance money grows for you over the last 20 years or so. Okay. And so with a historical view, then we can do some projections. All right. And it's at the low end. Okay, so the averages we're saying it's going to be about 6%. Our clients last year made somewhere between 14 and 18% on their money, but we're just doing this projection at 6%. I need you to follow along with me. So the premium here is $500 a month. Some of that money goes to pay for his insurance. Some of that money is put away for cash value, to build cash value. $500 a month, folks. Okay, that is going to be $6,000 a year. All right. And so when they're putting away that $6,000 a year, I need you to go ahead, take a look at the first year here. He's starting out with a death benefit. This particular person is starting out with a death benefit of $347,000. Age 26. Starting out with a death benefit of $347,000. And the way that this policy is constructed, that death benefit is going to continue to grow and grow and grow. So the next year, putting in another $500 a month, another $6,000 a year, I need you to see now the death benefit after year 2 is $352,000. Let's take a look at year 10. I need you to take a look at year 10 after $60,000 of his money is invested into this IUL, okay, to buy insurance and to build cash value. All right. So now the cash value on this after 10 years is $60,827. So he has $60,000 cash value in this policy already. What's great about having this money is cash value is that you can actually borrow against it. You become your own bank. All right. Let's just say they want to take out $40,000 to buy a car. By taking $40,000 out, they're not taking $40,000 out of their $60,000. They're borrowing that money from the company. Their money continues to work and grow interest and dividends. They're borrowing the company's money, and they have to give it to you whether you're working or not, because that's the way it's set up. Do you know this is a little known trick of the rich to use permanent life insurance to help to leverage that and to build their businesses? Oh my goodness. So he's borrowing the money, and guess what? If he got that money from his bank or credit union to buy the car, he would set up a payment program, wouldn't he? And then by setting up a payment program, then he's got to pay interest to another banking institution. Do you know he can set up the same program for himself and pay himself that interest? And guess what? When the loan is paid off, the insurance company has to pay him interest on that interest. So he's now building up his bank even larger. All right. I want you to show you something after 20 years in this thing. All right. He's paid in $120,000 after 20 years. I need you to see this. After 20 years, paid in $120,000, but his cash value is up to $197,000 already. And his death benefit on the life insurance has grown to over $500,000, paying the same $500 a month for 20 years. Oh. After 30 years, he's got $180,000 in. How much is the cash value? $468,000. How much is the life insurance part? Oh, his death benefit is now $800,000. But see, Don, you're saying, you mean he has to die to realize that $800,000? No. You see, with these kinds of policies, they have what's called living benefits. Living benefits. Let's just say they needed that money for a covered surgery. There's a certain amount of that money you can access. What if you get what's called a chronic diagnosis, something that is going to be with you for the rest of your life? Do you know there's a certain amount of this money you can access early while you're living? And God forbid you receive a diagnosis that's terminal. You can receive an even bigger amount of that money. You don't have to die to use it. They're called living benefits. So you got living benefits. You got the ability to borrow money against it. Oh, and this is after 30 years. Let me show you what we're going to do when he reaches retirement. He's still going to be able to access his regular retirement amount, okay, while he's building his own bank. All right. Now, here's the other thing. When he reaches the age 65, he'll have, after putting in $6,000 a year for those many years, he's going to have $240,000 put in. But guess what? Cash value, $1 million. Insurance payout, death benefit, $1,343,000. Putting the same $500 a month in and doing everything else. Oh, but remember, at age 65, he's not going to pay another dime into this thing. He stops, and set it up so he can take out of that money $84,000 a year out of this policy that he can spend any way he wants, tax free. Tax free. Did you hear me? I need some people to tell me what they think about being able to bring that money out tax free. Oh my goodness. Now, here's what's great. At age 65, he'll be able to take out $84,000 a year out of this policy. And in 10 years, $84,000 a year for 10 years, that's $840,000 taken out of the policy that he can spend any way he chooses, tax free. But he only put in $240,000 into his bank. $240,000, and in 10 years he can take out $840,000. And remember, his cash value when he started into his retirement was $1,525,000. So $1 million cash value, and he's taken out over the next 10 years. He's taken out $840,000. That's at $84,000 a year, and what? Cash value, the value of the account. Oh my goodness, $1,948,000. Oh my goodness! I wish they had some an insurance agent come up here and to validate all of this, because see, I'm not a licensed insurance agent. I hire insurance agents, and this is something that we did for one of our clients, who's not only paying off his debt in record time and saving interest, but taking that money and investing in their own bank. So these are the things that we're talking about, folks. You can use permanent life insurance to build your own bank. Oh man, Flame, I listen, we set all of this up just to show here is one way that the super rich are using this way of doing things. Here's another thing, folks. Do you know that other policy that he has? That other money that he's growing in the other investments? Do you know when he dies, it's heavily taxed? It's heavily taxed when that person dies to pass that money on. Do you know how much tax he's going to get hit with to pass this money on from his IUL over to $0? $0. Somebody says, how do I get to see the report? It should be on the screen. It should be on the screen. All right. $0. Insurance money passes on to your descendants. It's not taxed at all. So listen, folks, this is going to be some great stuff. Over $1 million gets to pass on while he's living well. And oh my gosh, tax free. Listen, folks, you're earning this money tax free in this. This is the way insurance policies are set up. Everything else gets taxed. It's either pre-tax or post-tax. Either way, it's taxed. This money, it grows tax free. You can become your own bank, your own family bank to pass this on. Do you know? And then, do you know what? When he has children, he can set the same thing up for his children. And all of these monies can be put into a trust. And it is a fantastic thing. And it can benefit generations using an insurance product that very few people know how to use correctly. If you want to know more about this, folks, hit me up on the back channel and says, I want to know more about that. If you want to have a savings and earnings report so that you can know how you can save money on all of your debt, pay off all of your debt in an average of 7 to 9 years, get a savings and earnings report, learn the month, day, and year you can be debt free. Oh my gosh. What we're going to do now, folks, is I want to put the book back up on the screen because the book is on sale. My book is on sale right now on Amazon. All right. You want to go to the link ice10k.com, and click on the link to get the book. Get the book or go straight to Amazon. My book is the only book out of 33 million titles that teaches you how to read an amortization schedule and go over what we went over today. I mean, here's an engineer that was on our
hold on, Mr. Ice.
Yes.
Mr. Ice, do me a favor. Do me a favor.
Yes, sir.
I need you to do me a favor.
Yes.
Can you do me a favor?
Yes. Yes, I can.
What I need for you to do is go to the bathroom, be a thing.
Okay.
Go get some water.
Yes.
That's what I need you to do. While you go into the bathroom and getting you some water, I got it from this point. Listen.
I just need you to know we got 3 minutes left.
Cool. If you guys got the book, put number 9 in the chat. If you don't got the book, put number 8 in the chat. We're going to find out the difference between 8 and 9. If you got the book, put number 9. If you don't, put number 8. No. We turned up. He's going to get some water. He's going to clear his throat because he gonna wrap this up in 60 seconds or less. If you got the book, put number 9. If you don't, put number 8.
Listen, folks, I want to appreciate you, Flame. Flame, I so appreciate you, man, working together with you. And we have to let our online people go on time, but we're going to hang out just a little bit late, just a little bit more on Clubhouse. So if you're on Clubhouse, don't go anywhere. All right. I just need you to know that you can get everybody that's online that's watching us. You can get the book. It's on sale. Take advantage. Get the book while it's on sale now. Okay. On Amazon. So go ahead and do that. All right. Now we're getting ready to shut it on down online, but I want to make sure that everybody online gets this and gets it well. We just went. Go ahead.
Between y'all relationship, your mom, y'all on a team.
Thank you, Flame. Thank you, brother. Listen, folks, I had a good time talking with you today. We got some really good information out there. We learned how to conserve our money, learn how to spend our money well so that we can live a great life and then get set up for retirement and then set up for generations to come using little known products like this to become your own bank. Folks, this is the kind of information you get right here with the P.I.L.L method. And I want to know, we're going to let Dr. Eric Thomas have the last word as we say goodbye to you. We're going to be right back here on Wednesday. And listen, we're going to be talking about something that is going to be so fabulous. That's going to be so fabulous. I need you to concentrate on one thing if you're buying the book. When you buy the book, read it and review it. We're going to put a slide up. We're going to produce a graphic that says read and review. Read and review. Flame, can you help us out to help the folks to read and review the book? All right. So when you get a chance, read and review, folks. Read and review. So we're going to be right back here in just a couple of minutes after we listen to Dr. Eric Thomas and we say goodbye to everybody online. Goodbye, everybody. We'll see you on Wednesday. My name is Don Daniel, founder of P.I.L.L Method International, and our team created the most powerful money management, wealth building, debt elimination system ever created. At our recent seminar in Nashville, Tennessee, the keynote speech was delivered by the #1 motivational speaker in the world, Dr. Eric Thomas. E.T., as he's also known, mentioned he paid off his mortgage in 4 years using the P.I.L.L method. I invite you to watch and listen.
Listen to me, y'all. One of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
Did you hear that? No mortgage, no stress. If you would like to become debt and mortgage free within an average of 7 to 9 years by cutting your interest costs by up to 75%, go to pillmethod.com and request a savings and earnings report today.